Every single day, millions of ordinary people open their phones, look at a stock price, and press buy. It feels instant, clean, simple. But in the tiny fraction of a second after you tap that button, an invisible process begins. One so fast, so complex, and so hidden from public view that most investors never even realize it exists. Because on Wall Street, the market you think you are trading in is not always the market that is actually trading around you. You see a price on your screen and assume that is the price you will get. Sometimes it is, sometimes it is not. And in the microscopic gap between your decision and your execution, some of the fastest firms on Earth are already reacting. Not with human instinct, not with human judgment, but with machines. Machines designed to detect, predict, and exploit tiny movements in price before ordinary investors can even understand what changed. This is the hidden architecture of modern markets. This is the world of high-frequency trading, arbitrage, and the speed war that quietly reshaped global finance. To understand how this system works, you first need to understand one simple idea: arbitrage. Imagine you are standing in a marketplace. A merchant on your left is selling a gold coin for $100. A merchant on your right is buying that exact same coin for $101. If you move fast enough, you can buy from the first merchant and instantly sell to the second. You take almost no risk, and you keep the difference. That is arbitrage. At its core, it is the act of exploiting tiny price gaps between two places selling the same thing. Now imagine doing that not once, not 10 times, but hundreds of thousands of times in seconds. That is where Wall Street changed the game. Because in modern markets, arbitrage is no longer driven by people scanning numbers on screens. It is driven by algorithms, server racks, microwave towers, and fiber optic cables. In this world, speed is not an advantage. Speed is the business model. In 2010, one of the clearest examples of this obsession with speed emerged in the United States. A company called Spread Networks began building an extraordinarily direct fiber optic route between Chicago and New York. They drilled through mountains, they crossed rivers, they cut a straighter path through the landscape. Not for oil, not for gas, not for passengers, but for information. Before that line, data moving between the futures markets in Chicago and the stock exchanges in New York took roughly 16 milliseconds for a round trip. The new route reduced that to around 13 milliseconds. 3 milliseconds. That was the prize. To most people, 3 milliseconds sounds meaningless. A blink of the human eye takes roughly 300 milliseconds. So why would anyone spend hundreds of millions of dollars to save just 3? Because in financial markets, 3 milliseconds can be the difference between reacting to a price and arriving after someone else already has. It can mean seeing movement in one market and reaching another market before slower participants have fully caught up. And when that happens at scale, over and over again, tiny informational edges can be transformed into enormous profits. This is the part most retail investors never see. The public thinks of markets as places where people simply buy and sell. But behind the screen is a competitive ecosystem built around latency, access, and positioning. The faster firm does not just move quickly, it sees the structure more clearly. It reaches the opportunity sooner, and it leaves everyone else reacting to a world that has already changed. That becomes even more important when you understand what happened next in retail investing. For years, brokerage apps promoted the idea of commission-free trading. The message was simple: Wall Street had finally opened its gates. Anyone could trade. anyone could participate. Anyone could invest like the professionals. And to millions of people, that felt like democratization. But Wall Street rarely gives something away for free without finding another way to get paid. When many retail investors place a trade, that order does not necessarily go straight to a public exchange first. Instead, it may be routed to large market-making firms through a system known as payment for order flow. Here is the basic idea. Brokerage platforms send customer orders to giant trading firms. In return, those firms pay the broker for that flow of orders. The broker earns revenue. The customer sees zero commission. And the market maker gets first access to a valuable stream of retail activity. Why is that order flow so valuable? Because retail orders are often considered highly predictable and relatively uninformed compared to institutional flow. And if you are a sophisticated market-making firm with better speed, better infrastructure, and better visibility into incoming demand, even tiny advantages in execution can be monetized over enormous scale. Not dollars at a time, not even cents at a time. Fractions of cents, microscopic edges, repeated millions and millions and millions of times. That is what makes this system so difficult for ordinary people to feel. The loss is usually invisible. It does not arrive like a fee on a monthly bill. It does not look like theft in the obvious sense. It looks like a slightly worse fill, a tiny difference.